What if leaving California could cost you hundreds of thousands of dollars, even after you've already moved out? That sounds unbelievable, but it's exactly why more high earners, business owners, and retirees are suddenly panicking. Quiet tax changes, stricter audits, and new enforcement rules mean California may still claim a piece of your money long after you think you're gone. And February 2026 is shaping up to be a critical deadline most people are ignoring. Here's the shocking part. Many people who escaped California taxes are now being audited years later, hit with back taxes, penalties, and interest. Why? Because California doesn't just look at where you live, it looks at when you earned, where you earned, and what ties you left behind. One wrong move, one poorly timed sale, or one forgotten business filing can trigger a massive tax bill. So is there really a California exit tax? Not one, but 10 different tax changes that can follow you out the door. Stay till the end because tax number 10 is the one that catches people after they think they're completely safe. Number 1. Residency Audit Crackdown. California has significantly tightened its residency audit enforcement, and this is where most people get blindsided. Simply changing your address, buying a home in another state, or spending more time outside California is no longer enough. Tax authorities now look at your entire lifestyle. Where you sleep, where your family lives, where your doctor is, where your mail goes, and even where you spend holidays. If California believes your departure is only on paper, they can still treat you as a resident for tax purposes. What makes this crackdown especially dangerous is how backward-looking it is. Audits often begin years after you've moved, when memories fade and documents are missing. The state reconstructs your life using credit card records, phone location data, social media activity, and travel patterns. If too many ties remain, California may decide you never truly left, triggering back taxes, penalties, and interest on all worldwide income. For high earners, this can turn into a 6 or 7-figure surprise. The practical takeaway is clear. Leaving California now requires intentional planning, not casual relocation. You need a clean break. New voter registration, new driver's license, new doctors, new financial accounts, and strong proof that your center of life has shifted. Keep detailed records from day one because the burden of proof is on you, not the state. If you're planning to exit before February 2026, this step is foundational. Without a defensible residency position, every other tax move you make is vulnerable, and California knows it. Number 2. Capital gains timing trap. One of the most expensive mistakes people make when leaving California is misunderstanding when capital gains are considered earned. Many assume that if they move first and sell later, the gains are automatically taxed by their new state. California doesn't see it that way. The state focuses on where you were a resident when the value was created, not just when the sale happened. If the appreciation occurred while you lived in California, the state may still claim its share, even if the sale closes months or years after you leave. This rule hits especially hard with stocks, real estate, private equity, and business interests. Imagine holding shares that grew for 10 years while you lived in California, then moving to a no-income tax state and selling them. California can argue that most of that gain was generated during your residency and should be taxed accordingly. Many former residents are shocked to learn that moving before a sale doesn't always shield them. The timing, documentation, and nature of the asset all matter, and California audits these transactions aggressively. The practical lesson here is planning, not guessing. Large asset sales should be coordinated carefully with your residency exit date, asset type, and holding period. In some cases, selling before you leave may actually be cleaner. In others, restructuring or spreading gains over time can reduce exposure. What you should never do is assume the move alone solves the problem. Capital gains are one of California's favorite audit targets because the dollar amounts are high and the rules are complex. If you don't plan this step deliberately, your exit could still come with a California-sized tax bill. Number 3. Stock options and RSU exposure. Stock options and RSUs are one of the most misunderstood tax traps when leaving California. Many employees assume that once they move, any future vesting or payout is taxed only by their new state. In reality, California applies income sourcing rules that look at where the work was performed when the equity was earned, not where you live when it vests or pays out. If you worked in California during the grant or vesting period, a portion of that income can remain taxable even after you've moved away. This becomes especially costly for tech employees and executives with large equity packages. RSUs may vest years after leaving, yet California can still claim its percentage based on time worked in the state. Stock options exercised after a move can also trigger California tax if the option was granted for services performed while you were a resident. Many people don't realize this until a W-2 or 1099 reports California source income, pulling them straight into an audit. The practical move here is advanced planning and precise record-keeping. You need detailed grant dates, vesting schedules, and work location timelines to calculate what portion of your equity is California-sourced. In some cases, accelerating vesting, negotiating grant terms, or delaying exercises can reduce exposure. Equity compensation can represent life-changing money, but it's also one of California's most aggressively enforced tax areas. If you're exiting the state with unvested stock or options, this is not something you can afford to guess on. If this video changed the way you think about leaving California, don't keep it to yourself. Scroll down and write one sentence about what shocked you the most. Your comment could save someone else thousands. Watch our previous video for a deeper breakdown on related financial moves. And if you value research-heavy content like this, please support us. Subscribe to the channel. It's just one click, but it helps us keep doing the hard work behind these videos. Number 4. Business exit and source income rules. Leaving California doesn't automatically mean your business leaves with you. This is one of the most expensive surprises for entrepreneurs and remote business owners. California uses source income and economic nexus rules, which allow the state to tax business income even after you've moved, if the business still has meaningful connections to California. That could be customers, contractors, property, inventory, or ongoing operations tied to the state. Many owners assume that changing their personal residence or registering the company in another state solves the problem. It doesn't. If revenue is still generated from California-based activities, the state may claim taxing rights. This includes online businesses, consulting, digital services, and e-commerce operations. California has become far more aggressive in asserting that income is California-sourced, especially when high revenue is involved. Moving without restructuring the business can trigger audits and multi-year tax exposure. The smart approach is to treat a business exit as a separate project from a personal move. Contracts may need updating, operations may need relocating, and California registrations may need to be formally closed. In some cases, continuing to operate in California might make sense, but you should do it knowingly, not accidentally. The biggest risk is thinking you've left when legally your business hasn't. If California can still trace income back to the state, your tax obligation may continue long after you've packed up and moved. Number 5. Wealth tax proposal risk. While California does not currently have a formal wealth tax, this is one area where policy discussions alone are already changing behavior. Lawmakers have openly debated taxing net worth, unrealized gains, or long-term accumulated assets, especially for high-net-worth individuals leaving the state. Even though these proposals are not law yet, they matter because timing matters. February 2026 is being closely watched as a potential line where future rules could look backward at when wealth was built, not just when someone moved. What makes this risky is the concept of retroactive reach. Some proposals have suggested taxing wealth accumulated while someone was a California resident, even if that person leaves before the tax officially takes effect. That possibility alone has triggered early exits, rushed planning, and aggressive audits. California has a history of enforcing new rules tightly once passed, and wealth-based taxation would give the state powerful tools to examine assets far beyond annual income, including investments, ownership stakes, and long-held property. The practical takeaway here is not panic but early preparation. Anyone with significant assets should be thinking about documentation, valuation dates, and residency timelines well before 2026. Establishing a clean break earlier can reduce future exposure if new rules appear. Waiting until legislation is finalized may be too late. Wealth taxes are politically sensitive, but financially tempting for states facing budget pressure. Even the discussion of them changes enforcement behavior today. If you're planning an exit, understanding this risk early could be the difference between strategic planning and a forced reaction later. Number 6. Trust and estate tax exposure. Many people assume that once they leave California, their trusts and estates automatically fall outside the state's reach. That assumption is often wrong. California can tax trust income based on several factors, including where the trustee lives, where the beneficiaries live, and where the trust was created. Even if you personally move out of the state, A trust tied to California can quietly continue generating taxable income inside California's system. This becomes especially dangerous for families with long-established estate plans. A trust created years ago while you were a California resident may still be considered California-sourced if a trustee or key decision-maker remains in the state. In some cases, even a single California-based beneficiary can trigger partial taxation. These rules are complex, poorly understood, and rarely explained until an audit happens. When they do surface, the tax bills can be substantial and unexpected. The practical step here is a trust review before relocation. Trustees may need to be changed, administration may need to move, and documents may need updating to align with your new state of residence. Estate planning is often treated as a set-it-and-forget-it task. But when you leave California, that mindset can be costly. Trusts are long-term structures, and California is skilled at following long-term income streams. If your exit plan doesn't include your estate strategy, part of your wealth may never truly leave the state. Number 7. Deferred income and bonus taxation. Deferred income is another area where California quietly keeps its grip long after you leave. Bonuses, commissions, retention payments, and other delayed compensation are often earned over time, not just paid at once. California looks closely at when and where that income was earned. If the work that qualified you for a bonus happened while you lived or worked in California, the state may still tax part, or all, of that payment, even if it arrives after you've moved. This catches many professionals off guard, especially executives, sales leaders, and high-performing employees. You might relocate, settle into a new state, and feel financially safe, only to receive a large bonus that gets flagged as California-sourced income. Employers may report it that way automatically, triggering tax obligations and sometimes audits. The timing mismatch creates confusion, but California's position is firm. Earning matters more than payment date. The practical solution is advance coordination. Before leaving California, review all deferred compensation agreements, bonus structures, and payout schedules. In some cases, accelerating income before the move or restructuring compensation terms can reduce exposure. In others, careful documentation can limit how much California claims. The key mistake is ignoring deferred income during exit planning. These payments often represent significant money, and California pays close attention to them. If you don't plan for deferred income properly, your exit may feel complete, until that one payment pulls you right back into California's tax system. Number 8. Exit year tax allocation rules. The year you leave California is one of the most dangerous tax years, yet many people treat it like a formality. California uses part-year residency allocation rules, which divide your income between resident and non-resident periods. The problem is that mistakes here are easy and expensive. If income is misclassified, California may treat more of it as taxable, even if it was earned after you moved. This commonly affects wages, business income, investment income, and one-time events like large sales or payouts. California looks closely at dates, contracts, and payment timing. If your move date isn't clearly supported by documentation, the state may push income back into the resident period. Even small errors can trigger notices or audits, especially for higher earners. Many people don't realize this year is scrutinized more than any other. The practical move is to treat your exit year like a tax project, not a routine filing. Keep precise records of move dates, work location changes, and income timing. Coordinate payroll, investment sales, and business transactions carefully. A clean exit year return reduces audit risk dramatically. California knows this is where people slip up, and they look here first. If you get the exit year wrong, every other planning step can unravel, even if you did everything else right. Number 9. Franchise and LLC wind-down taxes. Many people believe that once a business stops operating, the tax obligations stop too. In California, that assumption can be costly. The state charges minimum franchise and LLC taxes simply for existing on paper. Even if the business is inactive, earns no revenue, or has moved operations elsewhere. If you forget to formally close or withdraw your entity, California may continue billing you year after year. This often affects LLCs, S-Corp, and small businesses created years earlier and left dormant. Owners move out of state, stop using the entity, and assume it no longer matters. But California still expects annual filings and payments until the business is officially dissolved or withdrawn. Miss those steps and penalties, interest and back taxes begin to stack quietly. Many people only discover this when they receive a notice demanding several years of unpaid minimum taxes. The practical takeaway is simple but critical. Leaving California requires administrative closure, not abandonment. Businesses must be properly dissolved, withdrawn, or restructured depending on future plans. Filing final returns and paying final taxes closes the loop. Ignoring this step can undo an otherwise clean exit and pull you back into California's tax system unexpectedly. If your goal is to truly leave, your business paperwork must leave too, cleanly, formally, and on record. Number 10. Retroactive audit and enforcement risk. The final and most underestimated risk is retroactive enforcement. California doesn't rush, it waits. Many audits don't begin immediately after you leave, but 2, 3, or even 5 years later, when the trail is cold and documentation is harder to find. By then, people feel safe, settled, and disconnected from California. That's exactly when audit letters arrive, reopening years you thought were closed. California tax authorities are especially aggressive with former residents who had high income, major asset sales, equity compensation, or businesses around the time of departure. They cross-check federal filings, employer reports, financial institutions, and prior California returns. If they find inconsistencies, residency dates, sourcing errors, or missing ties, they can reassess past years, adding penalties and interest on top of the original tax. At that point, the burden of proof is on you. The practical lesson is long-term thinking. Leaving California is not a one-year decision. It's a multi-year audit risk window. You need to keep records, maintain consistency across filings, and avoid casual mistakes that contradict your exit story. The biggest trap is assuming silence means safety. Often, silence just means the review hasn't started yet. If you plan your exit carefully, document everything, and stay consistent, you reduce the risk dramatically. But if you rush the move or cut corners, California has the time and the tools to come back later and collect. Leaving California is no longer just about packing your bags and changing your address. It's about strategy, timing, and awareness. As you've seen, what people casually call the California exit tax isn't one rule or one bill. It's a web of residency tests, sourcing rules, deferred income traps, business obligations, and audit risks that can follow you years after you think you're free. Miss just one piece and the cost can be enormous. The most important takeaway is this: California plans long-term. The state doesn't rely on emotion or headlines. It relies on data, documentation, and patience. If you leave without preparation, California has the tools to reconstruct your life later and decide whether you truly exited or just relocated on paper. That's why February 2026 matters. Policy shifts, enforcement trends, and ongoing proposals suggest that scrutiny will only increase, not decrease. This doesn't mean people shouldn't leave California. Many do, and many do it successfully. But the difference between a clean exit and a costly mistake comes down to planning early and acting deliberately. Residency proof, income timing, trust structures, business wind-downs. These aren't optional details anymore. They're essential steps in protecting what you've built. If this video made you pause, that's a good thing. Tax mistakes aren't loud when they happen. They're quiet, delayed, and expensive. The goal isn't fear, it's clarity. Understanding the rules gives you control, and control gives you options. Whether you're leaving next year or just thinking about it, being informed today puts you ahead of most people. Now I'd love to hear from you. Are you considering leaving California, or have you already made the move? What surprised you most in this video? Share your thoughts in the comments. Your experience may help someone else avoid a costly mistake.